going on, everybody? Ryan Thompson, the Assumable Guy. This is the Assumable Guy Show. Today we're getting into a question I get asked all the time. All the time. Can I assume a mortgage if I'm self-employed? So if you own a business, you're a contractor, a freelancer, you drive for yourself, you're 1099, this one's for you. Here we go. Let me just answer it right up front because that's how I like to do it. Yes, you can absolutely assume a mortgage if you're self-employed. And I'm going to go one step further. In a lot of cases, it's actually easier for you to get into an assumable than a regular loan at today's rates. Sounds backwards, I know. Stick with me and I'll show you exactly why. First, let's talk about what you've probably already been through because I've watched this play out with so many buyers. You're self-employed, business is good, you're bringing in real money. You walk into a bank to buy a house and they pull your tax returns and basically tell you you're broke, right? You write off your truck, your gas, your equipment, your phone, your home office, all the stuff your accountant tells you to write off so you're not handing half your income to the IRS. Smart move at tax time, but now on paper, you look like you make a fraction of what you actually take home. And the lender doesn't care what's sitting in your bank account. They care about that one number at the bottom of your return, so you get squeezed. The harder you work to lower your taxes, the less house they tell you you can buy. It's frustrating. I get it. Now here's something a lot of people don't know. When you assume an FHA or a VA loan, the bank still has to approve you. They look at your credit, your income, your debt. It's real underwriting. So you might be thinking, okay, Ryan, if my tax returns are the problem, there's still the problem on an assumption, right? What actually changes? Think about that for a second, because the answer is the whole reason I'm doing this episode. It's the payment. That's it. That's the secret sauce. When you assume a loan at a rate in the twos instead of getting a brand new loan at 6.5%, your monthly payment is way lower. And the lower the payment, the less income you have to show to qualify for it. So let me show you what that looks like with real numbers. Say you're buying a $450,000 home. The seller's got a loan around $400,000 locked in at 2.5%. If you went and got a brand new loan on that same $400,000 at 6.5%, you're looking at about $2,530 a month, just principal and interest. Assume the seller's loan at 2.5%, you're at about $1,580 a month. That's roughly $950 a month less, $950 on the exact same house. This is where it gets real for self-employed folks. The bank qualifies you on your debt to income ratio. Smaller payment means you need less income on paper to cover it. So that tax return that got you a flat no on a 6.5% loan, on the assumed payment, it can actually qualify you. The low rate isn't just saving you money every month. It's the thing that gets you through the door in the first place. That's the part nobody explains to self-employed buyers. And real quick, while we're here, everyone can assume a mortgage. Everyone. Investors, W-2 employees, veterans, non-veterans, and yes, self-employed business owners. Everyone. If a bank or an agent tells you that you can't assume a loan just because you're self-employed, they're wrong. If it's an FHA or VA loan, it is assumable. Do not take that as your answer. Do not let it stop you. All right. Let me walk you through what you're actually going to need because there's a real bar here and I'm not going to make it sound easier than it is. The bank's going to want 2 years of tax returns. They average your net income, the number after all your write-offs. That's just how self-employed income works on any loan, assumable or not. So if your business is 6 months old, that's going to be tough. I won't pretend otherwise. But if you've got 2 solid years behind you, even with aggressive write-offs, that low payment gives you a ton of breathing room. Let me tell you about a guy I worked with. Marcus owns a small HVAC company, couple trucks, couple employees, slammed all summer. On paper, his income looked thin because he writes off everything like every smart business owner does. 3 different lenders told him the most he could buy with a conventional loan was around $350,000. That would have run him about $2,200 a month. He's got a family. He needed more room than that. So we found him an assumable at 2.75% on a $430,000 home. He brought $63,000 to cover the equity gap, cash he'd been sitting on from a couple good years, and his payment on that bigger house, about $1,500 a month. The banks wanted to box him into a smaller house that cost more every month. More house, smaller payment. Makes no sense until you realize the rate did the heavy lifting, not his tax return. Now let's talk about that equity gap, because for self-employed buyers, this is the other piece. The equity gap is the difference between the sale price and the loan balance. That's what you bring to closing. It's not really a down payment. It's the seller's equity you're stepping into. And self-employed money is lumpy, right? Big year, nice cushion. Slow season, things get tight. So if you've got cash from a strong year, this is a great place to put it. And if you don't have the whole gap, we've got options. A second mortgage from a partner lender where you put 5% down and they cover the rest. A HELOC on another property. A loan from your retirement account to yourself where you pay yourself back with interest. Cool. And before anybody freaks out about a second loan, let me show you the math because it surprises people. Say that gap loan is $75,000 at 9%. Sounds high, I know, but the assumed payment plus that second payment still lands around $2,180 a month. A brand new $475,000 conventional loan at today's rates, right around $3,000 a month. So even with the expensive second loan, you're saving over $800 a month. I promise you, I run this exact math for people every single week. So what does $950 a month actually mean for you? It's a truck payment. It's finally maxing out a retirement account you keep meaning to start. It's a real family vacation every single year. Every year. That's what the rate is buying you on top of the house. I want to make this super clear though. You still have to qualify. This is not a loophole where income doesn't matter. The bank's going to look at you, your credit, your returns, all of it. But the bar is the payment, and the payment is low, so the bar is low. That's the whole advantage, and for self-employed buyers, it's a big one. So, if you're self-employed and somebody told you you can't afford the house you actually want, do not take that as the final answer. Run the math on an assumable first. Go to assumableguy.com or DM me on Instagram at theassumableguy. Tell me what you do for work and what the banks have been telling you. I'll run the numbers for you. No pressure, just math. Next episode, this one's for the sellers. What if you owe more than your home is worth? You feel underwater, you think you're stuck, you think you can't sell without writing a big check at closing. I'm going to show you how your assumable rate can still get your home sold and why being underwater might not be the deal breaker everyone says it is. Let's go. I'm Ryan Thompson. This is the Assumable Guy Show. See you on the next one.